All right, hello, and welcome back to the Broken Business Models podcast. We are your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer nothing in this podcast or any of our other materials should be taken as investment advice. James or I could have positions in any of the stocks we may mention, and we may change those positions at any time. So make sure to do your own work and consult with a professional before making any investment decision. The topic of today's podcast is going to be Ginkgo Bioworks. So, Ginkgo Bioworks is a startup that is involved in the biotech industry that went public at the height of the SPAC mania back in 2021. At the time of their SPAC, they had a huge amount of investor hype. They had a market valuation of about $15 billion, which I believe is one of the biggest SPACs of all time. And one of the reasons that they had so much investor hype is because they promised to revolutionize many industries with their synthetic biology technology. Specifically, how they plan to monetize their synthetic biology technology is by their business model of downstream value, which basically means that they're going to sell their research services to their customers and then take a royalty for any products that their customers end up commercializing as a result of Ginkgo Bioworks' synthetic biology. So this was the cause of the huge investor hype and their huge valuation. However, in the 3 years since they went public, this downstream value business model has failed to pan out to any meaningful degree, and to the point where the company in the last quarter, we talked about this in our previous video, actually said that they're abandoning this entire business model of pursuing downstream value. Now, instead, they're just selling their research services as similarly to any other research organization, selling their services for a fixed price upfront. So for any of you who may not be as caught up on the business model of Ginkgo Bioworks, just a quick summary. Basically, what Ginkgo Bioworks does is cell engineering. So what they'll do is they'll develop genetically modified bacteria or yeasts that have certain desirable properties. For example, these yeasts could have applications such as secreting chemicals that could be useful for anything from developing new medicines or all the way to secreting chemicals that can be used to make fake meats and other such things. So up until this point, Ginkgo's synthetic biology technology has failed to allow any of their customers to successfully commercialize any significant product. And thus, Ginkgo Bioworks has not been able to receive any significant royalties from these products that are made using their synthetic biology. Now, they just recently released their third quarter earnings just the other day. And this is the first quarter after they announced that they were abandoning their downstream revenue business model. And so now that we have their first quarterly report since then, it's a good time to take a look and see what's the status of their business at this point and what are they saying about it. So for that, I'll hand it over to you, James.
Thank you, Ryan. So as Ryan explained previously, Ginkgo Bioworks used to pursue the downstream value business model. Now they're saying they're changing their strategy. They're no longer pursuing downstream value. So their only revenue is just going to be the upfront payments that their customers pay them to develop their synthetic cells in biology. And we can indeed see in the most recent quarter, the third quarter of 2023, there was indeed zero downstream value. Now, the headline number actually looks pretty good. Their cell engineering revenue more than doubled versus the prior year, from $37 million up to $75 million. However, we have to drill down a little deeper. And here they disclosed that in the third quarter, they recognized $45 million of non-cash deferred revenue from Motif Foodworks. So that is actually $35 million or $45 million. That's more than half of their revenue came from this non-cash deferred revenue that was recognized from Motif Foodworks. So what is Motif Foodworks? Well, if you've watched our previous videos about Ginkgo Bioworks, we've actually talked about Motif Foodworks in the past. Motif Foodworks is one of the so-called platform ventures that Ginkgo Bioworks created. So Ginkgo Bioworks creates Motif Foodworks, which is a company that is trying to develop fake meat, and they spin it off as an independent company, deconsolidate it from their balance sheet, and then Ginkgo Bioworks provides services to Motif, and then Motif gives them revenue in return. But Motif, instead of giving them cash as revenue, gave them non-cash consideration, which is equity. So it's a bit confusing, but Ginkgo Bioworks itself creates Motif Foodworks, this company that they created that is trying to develop fake meat. They spin off Motif as an independent company and deconsolidate it from their balance sheet. Motif Foodworks then signs a deal with Ginkgo where Motif gives some of its own equity back to Ginkgo. In exchange, Ginkgo provides services to cell engineering services to Motif Foodworks to develop new chemicals or whatever for their fake meat. Now, during the third quarter, in September of 2024, Motif Foodworks ceased operations. And the reason that they ceased operations is because they've been in a long-standing litigation with Impossible Foods. Impossible Foods is the company that makes the Impossible Burger. Impossible Foods alleged that Motif had, stolen their technology and is infringing on their patent. So Motif is allegedly infringing on Impossible Foods' patent. Impossible Foods sues Motif. This litigation has been going on for a long time and has been very costly. The legal fees have been very costly. So Motif could no longer afford to pay for this litigation. So in September, they announced that they are ceasing operations. So Motif now no longer exists. It is worthless as a company because it ceased operations. Yet if this company is worthless, how is Ginkgo Bioworks recognizing $45 million of non-cash compensation from Motif? Well, what happened was Motif paid equity to Ginkgo in the past in exchange for services that Ginkgo would provide to Motif going forward. And that created a deferred revenue. Then Ginkgo Bioworks recognized deferred revenue from Motif. So Ginkgo gets this $45 million of Motif equity, and over a period of years, Ginkgo Bioworks will provide the services to Motif, fulfill the performance obligation, and eventually recognize that deferred revenue. Now that Motif no longer exists, that performance obligation that Ginkgo Bioworks had to Motif has now disappeared. You cannot provide services to Motif because Motif has ceased operations. That performance obligation disappears. Therefore, Ginkgo Bioworks, as an accounting technicality, recognizes the $45 million of deferred revenue. However, that $45 million of deferred revenue is in the form of Motif equity, which is now worthless. So at the same time that they recognize $45 million of revenue, they also have to recognize a $45 million impairment on the Motif equity, which is now worthless. Now, this is a complicated story, I understand, but the point is this $45 million, which was the majority of their cell engineering revenue in the quarter, it wasn't really real revenue. It was just an accounting technicality based on their related party, Motif Foodworks, ceasing operations, and there's some accounting technicalities around that. This $45 million never really existed. There was never actually $45 million of cash. It was this, basically fake equity that is now completely worthless because Motif has ceased operations. And it's important to note that Motif Foodworks, to my knowledge, they have never even sold a single burger. This company, they have never sold a single burger to an end customer, at least not that I know of. They never even commercialized the product. Yet, over the years, Ginkgo Bioworks has been able to recognize tens, if not hundreds of millions of dollars of revenue from Motif Foodworks, despite the fact that Motif Foodworks has not even sold a single burger. That is why Ginkgo Bioworks deconsolidated Motif in the first place, because it allows them to recognize this kind of fake revenue. And that is one of the big concerns with Ginkgo. If you've watched our previous videos about Ginkgo going back, many months, actually many years, this was the main concern with Ginkgo is their heavy use of related party revenue in non-cash considerations. And we can see this chart I created here. So Ginkgo Bioworks discloses they have their reported revenue, which is the line in blue, and they disclose how much of that is from related parties, and then how much of that is non-cash consideration. So I consider, what I consider to be the real revenue is the revenue from third parties, not related parties. Because when you look at the related party revenue, it's this crazy weird deals that they create with Motif Foodworks and these other customers that they create for themselves. As far as real revenue from third parties, that is the orange line here. And we can see the orange line has actually been slightly decreasing over the past couple of years. And then this massive increase in reported revenue on the blue line, that is purely this, accounting technicality with Motif Foodworks. So the actual revenue has been declining, and that's very important to consider. Now, Ginkgo Bioworks, for many years, has been talking about, they would say, oh, we have a partnership with this massive company, and that'll eventually allow us to generate a lot of revenue. And so here they have this slide where they talk about, oh, we had this deal going all the way back in June of 2022. We had this deal with Novo Nordisk. Novo Nordisk is a massive pharmaceutical company, huge company, right? So Ginkgo gets their foot in the door of June of 2022. And then over the course of the next 2 years, they claim that their partnerships with Novo Nordisk has been this huge success, and they keep expanding their relationship with Novo Nordisk because it's so successful. And they talk about many examples like this. Oh, we're working with Novo Nordisk, we're working with Pfizer, we're working with XYZ giant corporation, and that's eventually going to allow us to generate a huge amount of revenue. However, they've been talking about this for years, but as we've seen, we look at this orange line, which is the third-party revenue, what I consider the real revenue, excluding their related party shenanigans. It's actually been declining. So if they really have all these great deals with Novo Nordisk and all these other big companies, why is the revenue actually declining? And the revenue is pretty minuscule. It's only in the most recent quarter, they only generated less than $30 million of third-party revenue. So it's, Ginkgo Bioworks has always been very good at releasing press releases, talking about all their partnerships with their supposed customers in Novo Nordisk and whatever, but it never results in them actually getting significant revenue, or it never results in them getting the revenue growth that you would expect when they talk about all these partnerships with these giant companies. And now, and again, as Ryan said, they used to always talk about, we're not generating that much revenue now, but just give us a few more years and eventually we'll get all this massive downstream value. As we talked about previously, this downstream value never materialized. It's basically just been BS. So that's why they stopped talking about the downstream value, and they say they're no longer pursuing that. And here, and this is a slide from their most recent investor presentation. They talk about, they have this new product offering of this synthetic biology services they're offering for their customers. And the most interesting part of the slide is this part down here. Attractive deal terms, fee for service only, no royalties, no milestones, and you own the data always. Our version of an easy button. So they're saying that, in the past they were having trouble landing customers because they would demand downstream value. They would say, if you use our synthetic biology services, you indeed create a successful product, you're going to have to indefinitely pay us a royalty for that. Many potential customers balked at that idea because they don't want to give up. They don't want to give up an indefinite royalty. They want to keep that for themselves. And that is why Ginkgo claims that in the past they had trouble signing on a lot of customers. Now they're saying we've abandoned the downstream value, so we are giving a much more attractive option for customers. And basically what that means is Ginkgo is becoming a traditional contract research organization, which there are many have existed in the past, many exist, is not a particularly sexy business model, is not something that would be worthy of a $15 billion valuation, that's for sure, which is what they had when they SPAC'd a few years ago. The entire bull case was around this downstream value, which they're now saying doesn't exist. However, they said that, without the downstream value, it'll be easy, without asking our customers for downstream value, it will be easier for us to sign on new customers, etc. Well, if that's the case, if it is really so much easier for them to sign on new customers now that they're not asking for royalties, why did their third-party revenue actually decline in the third quarter, which is the first quarter after they stopped asking for royalties? They stopped asking for royalties, And they said the whole reason they did that is so that they can get more customers and generate more revenue. But then the revenue actually declines. So it's clearly not working out. And so Ginkgo Bioworks has incurred operating losses since inception. The upfront payments that they receive from their customers has never been enough to cover their own operating costs. In the past, they've said, yeah, we're losing money now, but once this massive downstream value materializes, that's when we're going to be profitable. Now, they're no longer talking about the downstream value because that has failed. The downstream value is not coming. It's gone. It was smoke and mirrors. So how is Ginkgo Bioworks going to become profitable? Well, they say we're going to do massive cost cuts. They say they're going to, by mid 2025, they are going to reduce their operating expenses by an annual runway of $200 million. And they're going to achieve this by laying off 35% of their staff and selling some of their buildings, their office buildings, etc. And they claim that they're already ahead of target for their $100 million of cost savings by the end of 2024. And then they're going to get them. And then by mid 2025, that is going to expand to $200 million of cost savings. So let's actually drill down into the numbers and see if these supposed cost savings have really materialized. Well, their mass layoffs began in June of 2024. And in fact, they even had to recognize $12 million of severance costs in June of 2024 in relation to their layoffs. In June of 2024, that is in the second quarter. So that means that by the third quarter, they had already done a lot of these layoffs. So we should start to see a benefit in terms of reduced operating expenses starting in the third quarter. However, if we look at their reported free cash flow, they actually burned more cash in the third quarter than they burned in the second quarter. So, despite the layoffs, they're actually losing even more money. And if we look at the run rate of cash burn, they burned almost $120 million in the third quarter of 2024. If you annualize that, that is almost $500 million per year of annualized cost burn. So even if you believe their target that they're going to reduce $200 million of operating expenses, they're still going to be burning a huge amount of cash. And that's not to mention that that's not even considering the massive stock-based compensation they do on top of that. So this company is losing so much money that even if they achieve these cost cuts that they're targeting, they're still going to be losing money. And when you lay off 35% of your employees, that comes at a cost. You had that's hundreds of people that you used to have. Now they're gone. So it's going to be harder for them to fulfill their obligations to customers because they have so many less people. So that's probably because they're losing so many people and the company is shrinking, we should probably expect the revenue to shrink as well, which is very bad, seeing as before they even started the layoffs, their revenue has been on a downward trajectory. Now they're going to lay off a third of their workforce plus reduce a lot of their real estate. Basically, the company is massively shrinking. So we should probably expect the revenue to continue deteriorating. The decline in the revenue should probably accelerate. And then finally, as Ryan described earlier, this was massively hyped up when they did the SPAC, had a $15 billion valuation. Since then, the share price has declined by 98%. So obviously anybody who bought shares of Ginkgo Bioworks at any time pretty much has suffered massive losses, billions of dollars of shareholder value destroyed. But who has actually done very well has been the insiders, the CEO and the directors and top management of Ginkgo Bioworks. Since the company went public, they have been net sellers of stock and they have sold $188 million worth of stock. So the insiders cash out to the tune of $188 million, while anybody else who bought into the stock, who believed all of the hype and believed their downstream value and all that BS, they have suffered catastrophic losses. This is what I call a classic case of a management enrichment scheme, where the insiders make out like bandits, while the retail investors and the people who naively believed the bull case, they got crushed and have suffered a near total loss. And then one final thing, you probably won't, given how crappy this company is, it probably won't come as a surprise that one of their biggest shareholders was Kathy Wood's ARK Invest, who has, one of the worst track records of any money manager ever. And she was, a huge shareholder of Ginkgo Bioworks. I think at one point, ARK Invest owned like 10% of Ginkgo Bioworks. They were one of the largest, if not the largest shareholder. Well, if you, as of, about June or July, it looks like they, ARK Invest sold their entire stake in Ginkgo Bioworks at a massive loss. And the situation is bad when a company is so bad that even Kathy Wood doesn't want to invest in it. So yeah, the situation is bad when even Kathy Wood jumps ship. So I think, Ginkgo Bioworks, it's the final nail in the coffin. They've admitted the entire bull case was the downstream value. They've now admitted that the downstream value is BS and the revenue is declining, and they're doing massive cost cuts, massive layoffs, which will probably result in revenue declining even faster. So this company, and they're losing huge amounts of money, and there's really no way that their cost cuts are going to bring them to profitability. So this is a complete failure of a company, one of the worst, if not the worst company we've ever talked about. I think this is maybe the third or fourth video we've made about them. If you can go back, we'll link in the description below. We'll provide links to the previous videos that we've made about Ginkgo Bioworks on this channel. And if you go back and watch our videos, every time we make a video about Ginkgo Bioworks, the situation gets worse and worse. And I think, logically, the only conclusion, this company, the business model, everything has been a complete and total failure. Could not be more of a failure. So I think really the only, if we look forward to 2-3 years down the line, the most realistic and likely option is that this company is going to cease operations and shut down, just like Motif Foodworks did. So with all of that, I think that's about everything we had to talk about Ginkgo today. As always, if you have any opinions or thoughts about Ginkgo Bioworks, please let us know in the comment section below, and we will see you all on next week's video.